Greetings, my name is Ted Hicks. I am the Chief Investment Officer for Hicks Associates Wealth Management. Today is Friday, December 1st, 2023. It's a little bit before the market opens, and this is our monthly market monologue where we are going to go into a little bit more depth than we typically do. And we're going to review the stock markets as well as some of the economic data, some good news on both fronts. So let's go ahead and dive in. We'll start today by looking at some of the economic data, and then we'll wrap up the video by looking at some of the stock market statistics. So first up, we want to look at the GDP histogram, which is on the screen right now. Focus your eye on the right-hand side of the chart where you see that third quarter GDP was initially announced to grow at 4.9%. However, it was recently revised upward so that third quarter GDP is now positive 5.2%. That's the official stat. The latest update has been revised upward. And that's one of the things that we want to briefly mention is that the number of positive economic surprises continues to surprise. We've had consistent economic good news, better than was forecasted. Happened again this week with some of the inflation data, which we'll talk about in just a minute. That said, when we look at the Atlanta Federal Reserve's GDP Now forecast, fourth quarter economic activity is currently forecasted to be positive 1.8%. So it definitely has come in off of that 5.2% growth from the third quarter, but this is still economic expansion. So that's still good news. Next up is inflation. This is the Consumer Price Index, and we'll get another updated data point on CPI on December 12th. However, just yesterday, we did get some other data released that's closely correlated to this. And the bottom line is the annual increase in inflation was the smallest in 2.5 years. Again, that's good news. Because of that good news, Federal Reserve officials are starting to forecast that they are most likely done raising interest rates, at least for now. As a matter of fact, the futures market is starting to believe more and more that the Federal Reserve might actually cut rates next spring. Next up, we have copper. We've been looking at this chart the last couple of months, and this is one of my go-to charts. Copper is frequently referred to as Dr. Copper because many have said over the years that copper has a PhD in economics, simply because copper does a relatively decent job of predicting recessions. Copper is an industrial metal. It's used in a lot of things. So when copper prices go down, it means the demand for copper is going down, which would imply that the economy is beginning to contract. So that's why we look at copper as much as we do. It is one of many things that we do, or one of many signals that we take a look at. So this is the chart that we were showing last month. Last month we had highlighted the fact that copper had kind of created this little support area, but had fallen through it and had kind of rallied just a little bit. Well, let's look at an update. It has climbed back through that level. So I would contend that this is certainly good news. I'd like to see copper prices continue to rise to give me even more confidence that the economy is going to expand. But so far, this is good news. In other good news, we have the credit index. Again, something that we looked at last month. I won't get into too much of the details. The bottom line is this credit index typically is going to increase as we're going into a recession. It's going to be above the zero line, and you can see it's right on that zero line. So despite the increasing interest rates in the economy, the availability of credit is still solid, and people are not having a problem. This is, again, indicating that this is not recessionary. So again, more good news. The next chart that we're going to look at is about debt payments and consumer debt payments. And before I get into the chart and actually show you the chart, I want to stop and mention something that's really important to me. And the reason why we look at the charts the way that we do is because we want to verify the data. We want to verify the data ourselves. One of my favorite scripture verses is from Acts 17:11, and it says that the believers in Berea were more noble than the Thessalonians, for they searched scripture daily to see if what Paul said was true. Now, obviously, that's theological, and we can take that offline. I'm happy to have that conversation if you want. But the point is, it still applies to this. When we see something happening in the news, I want to look at the data to see, is that newscaster telling the truth? When we see, especially in social media has many redeeming qualities. There are many challenges with social media as well. And one of the challenges with social media is that we can get into what we'll call an echo chamber. typically speaking, we connect with other people on social media who are of like mind. And it can become an echo chamber, and we can get what we refer to as confirmation bias. Recently, a friend of mine posted or reposted I think it was a TikTok video, and the video was of somebody crying because they're having a hard time. They're living paycheck to paycheck, and this person was indicating, well, how is anybody making it in this economy? And the video cuts to somebody else, and it was somewhat humorous, but this other individual was confirming the first video, and they're saying, yes, it's true, people are really struggling, but hey, I bought crumble cookies anyway. Well, that is certainly true for those two people in particular. I don't doubt that authenticity. However, I want to look at the broader picture and to see are more and more Americans struggling? Don't get me wrong, there are absolutely Americans who are struggling. That is always true. And if you are not one of those, then I would argue in this season of giving, you should consider increasing the amount of your generosity to help those who are in need and who are struggling. So that's another video for another day. But the point is, if we're not careful, we can get caught in an echo chamber, and we get caught by confirmation bias. We think this is true, so therefore when somebody says it, see, they agree with me. So we need to be very careful, and that is one of the reasons why we have a tendency to look at the data. We want to see the data ourselves. What does the data actually say? So let's go to the chart. Again, this is the consumer debt service payments as a percent of disposable income. Now, one caveat is this is a little bit of a stale data point. I expect another refreshed data point here in the next week or two. That is one of the problems with this particular data series. It is only updated quarterly. However, look at the chart. The data is saying that it's about 5.84%. Has that increased? Yes. After COVID, this data series got really, really low, almost to all-time lows. And it has naturally increased. Well, that is called a reversion to the mean. It's reverting back to something that is historically more appropriate. The question is, has it gone too far? And so it rose really, really quickly, but the last two data points have corrected back down. So my concern here is not the level, it is the direction and the rate of change. My concern is how quickly it went from this really low level to this high point here. However, it's corrected back down. So I'll put it in the January monthly market monologue to see what is the latest data point. But if you look back through history, look at where this data series was prior to the global financial crisis, prior to the dot-com crisis. It has definitely been higher than it has before. So it is a concern, but I'm not overly concerned. I'm not too concerned with this just yet, mainly because it's ticking back down. Again, not diminishing the fact that some people are indeed struggling. And again, if you are blessed, I would encourage you to be a blessing to somebody else, be a blessing to a stranger this Christmas season to help those who are in need. But I'll get off my soapbox and we'll move on, and we'll look at the yield curve, because this is one of the things that we are still a little bit concerned about. Again, this yield curve is the 10-year yield minus the 3-month yield, and it is still inverted. And by that, we are referring to the fact that the yield curve is negative. When you take the yield on a 10-year bond and you subtract the yield that you could get on a 3-month bond, the answer is negative. It is below this zero line, and it was uninverting, but it has corrected back down. So this is still a concern, because the data suggests that the yield curve so far has 100% accuracy in terms of predicting a recession. So we do need to be careful that it could very well be giving us a false signal, and that is why we look at the weight of the evidence. What is the weight of the evidence? Not just one data point. We don't want to look at and make a decision off of one data point. What is the weight of the evidence? What is it telling us? So this is one of those things that has still got us a little bit concerned. So we'll transition now and review some of the stock market data for the month of November. And first up is our seasonality chart. As a reminder, this shows us the average monthly performance for the S&P 500 dating back to 1950. And the blue dot represents the 2023 performance for the month of November. And you can see November is historically a good month, but this November 2023 was far better than the average November. As a matter of fact, it's well above average regardless of the month. And it appears that it was the 18th best monthly gain dating all the way back to 1950. So November, strong month. This particular November was abnormally strong. Now, what that sometimes means is that we could reasonably expect a little bit of a market pullback. I don't know if that's going to happen, but when you have such a robust rally, sometimes the stock market needs to take a day or two off, sometimes a week or two off. We'll see if that happens. But for the S&P 500, a very strong month indeed. As far as the small cap index, again, this is dating only back to 1995 because that's when small caps came to be classified. But again, November historically is a good month for small caps. Again, this November of 2023 for the small companies was also well above average. However, we want to look at the broader market as we have discussed all year long. The S&P 500 is great, but you know it has been pulled all year long by just a handful of stocks. I'm going to give you another update on that in just a minute. So we want to look at a little bit broader measure. This is IWV. This is the Russell 3000. And again, it's capturing approximately 3,000 stocks, and it is getting approximately 90% of the stock market. And what we really want to look at is what percentage of this universe are above these various measures. Again, the 20-day moving average is really about 1 month. The 50-day is approximately 2 months. And then you have the 200-day moving average, which is generally considered to be that long-term trend. And you can see there's a steady increase in all of these measures. That is a very good sign. However, if we look at the entire year, you can see how these measures were oscillating above and below this 50% marker. It's good news that these measures are increasing, but what we are trying to illustrate and what we've been talking about is that this year has really not been a bull market. It's been a bull market for a handful of stocks, but it's not really been a robust bull market where everybody is participating. What do I mean by a robust bull market? Well, if we rewind the videotape, here's IWV, and you can see on the screen, this is 2016 and 2017, and you can see what percentage of this particular ETF was above the 200-day moving average during that time period. And you can see in early March of 2016, it crossed the 50% threshold and stayed there for more than 2 years. That is a strong bull market. That is not what we have seen this year. And another example would be this is after the COVID crash, where as the market recovered, everybody is, for the most part, participating. That is not what we have seen this year. So let's talk again about cap-weighted versus equal-weighted to give you another update in this regard. So as you know, the S&P 500 is cap-weighted. It is weighted by the capitalization of the company. So the largest 7 stocks has come to be known as the Magnificent Seven. They have an outsized influence. This is an equal weight index that I created to demonstrate what the Magnificent Seven stocks are doing. And by the way, this is that consolidation period that I just mentioned. So the 7 stocks have rallied off of this support level, but lately they have kind of taken a breather. And we see that in the S&P 500 and a lot of indexes actually. But to give you an update, remember from last month's video, we talked about this is how the S&P 500 is calculated. Every company in the index is not given equal weight in terms of how the index is calculated. So what we end up seeing is these top 7 stocks end up accounting for approximately 26% of the S&P 500's performance. What does that actually mean? Well, if it was equally weighted, the S&P 500, if the S&P 500 was equally weighted, those 7 stocks would only represent about 1.4% of that index. So these 7 stocks really have an outsized influence, and they've had fantastic years. So those are the Magnificent Seven stocks, and that is their rate of return as of the end of November. And you can see this far right column is showing you the impact to the S&P 500. So these 7 stocks have given the S&P 500 a 23% rate of return. However, through yesterday, the S&P 500 is only up 19. I say only. It is only up 19.85%. So how can these 7 stocks contribute 23% of return to the S&P 500, but the S&P is only up 19.85? And the reality is the vast majority of the stocks are negative for the year. It's starting to look better, but it has not been a very robust bull market. So shifting gears and looking at some of the equal weights on the screen right now, we have the 11 sectors of the S&P 500, but instead of the cap weighted versions, this is showing us the equal weight components and the equal weighted versions of these particular stocks. Want to zero in on financials. This is the financial sector, one of the sectors that has really struggled all year long. And you might recall, it's been so long ago, but you might recall the banking crisis that happened earlier this year with Silicon Valley Bank collapsing and a handful of others. Well, all year long, the financial sector has really struggled. But what we see here lately, yesterday had a really positive day and breaking out above this July and August high. But look over here. This is showing us that out of the stocks that are in this ETF, more than 98% of them are above their 50-day moving average, and almost 80% of them are above their 200-day moving average. So the financial sector has really come alive, and I believe, off the top of my head, I believe the financial sector accounts for approximately 12% of the S&P 500. But if these guys can finally break out and finally recover from this banking crisis, it would be a very, very good sign. Another good sign that I thought we would share, we'll probably land the plane after this one, is the real estate sector. Real estate has really struggled. The real estate sector has really struggled. And you can see the black line is our 200-day moving average, and that's a pretty nice gradual slope down. This has really struggled to get above that indicator. Well, we can see 87% of the equal weight real estate is now above the 200 or above the 2-month average or the 50-day moving average, and we're just barely above 50% of them are above the 200-day moving average. So the real estate sector is starting to improve as well. It's too early to say for sure if that's going to really begin to rally. But this has been one of the weaker sectors, and the fact that we are seeing some improvement there is good news. But we really need to see it break out above these July and August highs. So anyway, we'll land the plane here. I hope these monthly market monologues are helpful. If you have any questions, by all means, feel free to send me an email directly. You can find all of our contact information at our website, hicks-associates.com. My email address is on the screen. And again, thank you for watching. If you haven't already, please hit that subscribe button. And again, we'll talk to you again soon. Thanks.